Good morning, everyone. It's good to see you all, and welcome to Ultra's presentation of the interim results for 2017. Before I start, I'd like to take a minute and say one thing in 3 parts about Ben Fidler. As you will all know, and have no doubt read, Ben has decided to jump over the fence and leave the analyst community to join Rolls-Royce.
What?
I'd like to publicly say how I have enjoyed working with Ben and wish him well in his future career. I hope one of you in the room will take up the mantle of only asking one question, which then turns into a whole page. On to the results. Ami will, as usual, cover the first half performance of the group, and I will then cover the geopolitical landscape, US defence outlays, the second half, and long-term opportunities. To allow more time for questions, we have retired updates of some previous slides to the appendix. The presentation and script will be available later this afternoon on our website. Please remember that this session is being audio recorded and is being transmitted on a webcast, even though I hate cameras. A transcript to the Q&A session will be available later this week. On to the overview. I am pleased to say that the results for half 1 2017 are in line with expectations, if not a little ahead of management expectations, as shown on this slide. The analysis and guidance that we presented at Ultra's 2016 prelims in March of this year have been realised, and we are on a trajectory to deliver the year end. There is no change to our guidance, based on the same pound-US dollar assumption made in March. The cash conversion of 53% reflects the higher capital expenditure this year and follows the usual cycle owing to dividend and tax payments, both occurring in the first half. We remain on track to achieve the guided full-year performance of around 80% cash conversion. With the continuation of the good cash conversion achieved in 2016, the balance sheet remains strong and the debt levels are within a comfortable range. I am pleased with the operating margin of 15.7%, which is in line with the prior period, despite the increased mix of engineering compared to production programs. The order book of £808 million is up from the start of 2017 and has increased by 2.8% from half 1 2016. This represents a pleasing book-to-bill ratio of 1.07. Ami will provide the customary detail, but suffice to say that I am very satisfied with the progress of our S3 initiative and that it remains on track to deliver at least £20 million of enduring savings by the end of 2018. As you are all aware, we have entered into a conditional merger agreement to acquire Spartan and completed the placement of 9.9% of equity in July since the period end. I am happy to take further questions on this acquisition, but may I remind you that since this is a Class 1 transaction, my answers are limited to public domain information. Let me now hand over to Ami to take you through the detail of the first half performance.
Thank you, Rakesh, and good morning to everyone. I'm pleased to present our interim results for the period ended 30th of June 2017. You will have seen the numbers for this slide earlier this morning, so I intend to only cover a few points. The group has closed with a good order book, improved order intake, and strong balance sheet. A lower tax rate has helped increase earnings per share. FX movements during 2017 clearly had a positive impact on most of our key indicators. For reference, sterling weakened 12% against the US dollar, with the average rate moving to 1.26 in the first half of 2017 from 1.43 in the comparable period last year. The order book was 808 million compared to 786 million at the end of June 2016 and 799 million at the end of December 2016. Looking at the order book increase compared to June 2016, the overall increase of 2.8% included 1.8% of organic growth and a foreign exchange benefit of 1%. Compared to the order book at the end of December 2016, overall growth of 1.1% included organic growth of 3.9%, offset by a foreign exchange reduction of 2.8%. Order intake increased 7.4% to 390.3 million, which takes order cover for 2017 at this stage to 82% compared to 84% last year. Foreign exchange accounted for 8.7% of the increase, disposals reduced growth by 2.8%, and underlying order intake increased by 1.5%. Order intake was strong in May and June, following the end of the continuing resolution. Revenues and operating profits were broadly flat at 366 million and 57.6 million respectively, leaving margins at 15.7%. Earnings per share improved by 0.3% as the tax rate reduced slightly to 21.5% compared to 2016. The dividend has increased by 2.8% to 14.6 pence, and operating cash flow of 30.5 million represented 53% cash conversion. Moving to the revenue bridge. The weakening of sterling against the US dollar increased revenues by 34.4 million or 9.3%. The ID business, Ultra's first divestment, was sold in August 2016 and diluted revenue growth by 10 million or 2.7%. This left an underlying organic decline of 24.6 million or 6.7%. This decline was due to the FY 2017 continuing resolution ending in early May, which delayed order intake and hence revenues compared to last year, when the FY 2016 continuing resolution ended in January 2016. Furthermore, there were a higher proportion of engineering contracts in our Communications and Security division compared to last year. I will talk about this later on. The profit section is shown at the bottom of the slide, which highlights the main drivers within the movement of operating profit. Currency increased profits by 4.6 million, or 8%. The ID disposal diluted profit to the tune of 1.6 million, or 2.8%. The effect of lower revenues led to an organic decline of 3.1 million. This included a transactional foreign exchange loss of 1 million, as a period-end US dollar rate moved from 1.23 at the end of 2016 to 1.30 at the end of June. I would like to take this opportunity to discuss IFRS 15, which is a new accounting standard on revenue recognition. This will be effective for the calendar year 2018, so we have undertaken a project to identify the changes it would make to our 2016 results. This project is nearing completion and has identified that even after applying the new standard, the majority of the group's long-term contracts will not produce different numbers. The changes we have identified arise from separating contract performance obligations and some transactions which will no longer be accounted for using long-term contract accounting. A substantial majority of transactions where revenues are recognized as control of goods passed to customers will not change either. Remember that the new standard will not change cash flows. Our auditors will be reviewing the project findings, including the changes that have been identified, and we will report further after this is complete. Turning to the next slide, which shows our investment to support future growth. You will see on the right-hand side that the acquisition and the spend was 6.8 million, reflecting retention payments relating to our 3 Phoenix business, which was scheduled at the time of acquisition. On the left-hand side, you can see the R&D spend for the period, which, in absolute terms, was 76.6 million in 2017, compared to 68.6 million in 2016, reflecting the increased customer-funded engineering. This represents 20.9% of revenues, compared to 18.7% of revenues in 2016. Ultra-funded R&D was 16.6 million in the period. Turning to cash. Operating cash flow of 30.5 million represented cash conversion of 53%, compared with 67% last year. Capital expenditure increased, as expected, to 4.8 million as our ERP implementations began. There are two in progress at the moment, one at our PCS business and the other at our CSS business. Both projects are on track, and one is scheduled to go live in the last quarter of 2017 and the other in the first quarter of 2018. A further 3 have been authorised and will commence in the second half. Working capital increased by 28 million over the first half of the year in advance of anticipated deliveries over the rest of the year. A breakdown is included in the box on the right-hand side of the slide. Inventories represented 6 million of the build-up in working capital, with a number of businesses increasing stock levels. The Communication and Security division has a greater proportion of engineering programs underway in the first half, and this contributed towards the increase in the debtor balance. Creditors decreased as we paid 3 million in previously accrued Oman legal fees in the period, as well as bonus payments, and released some risk reserves on international sonar programs that are coming to an end. Moving on to net debt. I'm pleased to report that closing net debt was similar to the year-end close position, remaining almost unchanged at 1.78 times, compared to 1.76 times at the end of December, and was substantially below the 2.3 times position at the end of June 2016. Looking at the various non-operating cash flow items, interest, tax and dividends were higher at 36 million, which was caused by cash tax paid being higher than the unusually low level of payments in the prior year. The US dollar has weakened against sterling over the half year, resulting in US dollar debt decreasing in value by 10 million. This foreign exchange difference represents most of the other balance. During the period, there were no changes to our banking facilities. Headroom on committed facilities was 194 million at the end of the period. We've received in some investor meetings questions around the growth in the 2016 amounts receivable from contract customers. I would like to take this opportunity to explain the movements in this line. Firstly, Hurley, as a new company to the group in 2015, included in error their 7 million amounts receivable from contract customers in the prepayments and accrued income line of the balance sheet. Had this been included in the right line, there would have been no significant increase other than FX. Secondly, the growth in H1 2017 is due to the increased number of engineering programs. As we have discussed previously, revenue and margins on those programs are taken in accordance with long-term contract accounting. As you know, we are prudent by taking lower margin on these early contracts. For completeness, we are including the geographic and segment analysis. UK revenues reduced from 24% in 2016 to 22% for the first half of this year, with the decline attributable to the disposal of ID and a number of UK programs ending last year. This reflects our previous comment that the UK market remains a difficult one. The rest of the world revenues grew by 2% due to international sonobuoy sales and increased international sales from our forensic technology business. As normal, we present the revenues by segment on the right for your information. The most significant movement was a lower C2ISR segment as a proportion of revenues, as the segment moved from 22% in 2016 to 19% for this first half. This was principally due to the disposal of ID. Maritime improved by 200 basis points to 8% due to increased spend on radar programs in the US. It is worth reminding everyone that each of our divisions go through margin cycles as they move through different phases, and this slide seeks to illustrate graphically where each division is at the moment. Further, depending on the type of engineering contracts awarded, some require Ultra to fund the engineering phase, whilst others attract customer funding. Research and development expenditure is typically highest in the Aerospace and Infrastructure division, as commercial aerospace programs are company funded. However, our aerospace activities are transitioning into production, and therefore R&D expenditure will be reducing as a percentage of sales in the second half of the year. In the Communication and Securities divisions, where the production of the crypto contract, ECURP, completed in 2016, there are a number of engineering contracts that are customer funded. The Maritime and Land division has a number of large production contracts with limited R&D programs. The consequence of this cycle is that total R&D will increase in the year. However, internal R&D as a percentage of revenue will decrease by the end of 2017. Moving on to how the three divisions performed. We start with Aerospace and Infrastructure. Both revenues and profits increased, with margins improving due to the continued weakening of sterling against the US dollar. Whilst the Communications and Security division saw an overall decline, when the ID business, which was sold in August 2016, is excluded, revenues in this division were flat. The operating profit decline, when excluding ID, was 8.5%, with 13 million compared to 14.2 million in half 1 2016. This was due to the greater level of development programs in the period when compared to 2016, and the continuing resolution, which has moved revenues out of the first half of 2017. Encouragingly, strong order intake, notably at our CIS division business, resulted in a 7.2% improvement in the order book. Looking at the Maritime and Land division, increased demand for both US domestic and international sonobuoys continued. The CR had an impact on this division as well, but margins improved due to the release of risk reserves as an international sonar program comes to an end. The aim of our S3 program is to reduce complexities within our group so that management can focus on growing their businesses rather than managing the back office processes. The program remains on track as we reach the midpoint, and the table summarizes the financial elements of the S3 initiative. From left to right, column 1 shows that the program has cost 3 million for the first half, and column 2 shows that cumulatively we have spent 14.4 million. The costs to date comprise project costs, together with onerous lease provisions, consolidation costs, and the costs of some headcount reductions owing to property closures. Column 4 shows that S3 has generated savings of 5.6 million in the first half of 2017, which on an annualised basis, as shown in column 5, represents 11.2 million per annum. This was in line with our expectations for the midpoint of the programme. The project continues with the estimated cost savings of 20 million per annum by 2019 unchanged. Finally, some thoughts on outlook. As we have indicated since the preliminary announcement in March, our performance is much more heavily weighted to the second half than usual. Our full-year guidance is unchanged for organic growth to be in the 0 to 1% range. The India Defence Systems contract, which was won last month, will not alter this as it is not scheduled to enter production until the end of 2018. We expect cash conversion to be around 80% in 2017 and to return towards our three-cycle target of 85% in the medium term. We expect organic growth to continue in 2018 and beyond. The speed and timing of this will be dependent on the annual US federal budget process. I provided a detail earlier on the current investment cycle. Moving forward, internal R&D is likely to be lower, while customer-funded R&D will increase, and therefore total R&D spend is a better guide to our investment plans. Our recent equity raise has reduced our debt levels until the acquisition of Spartan is complete. Our net debt to EBITDA ratio at the end of the year will therefore reflect this. The Spartan acquisition process continues, with the shareholder and regulatory approvals in progress. We will update in due course. The estimated completion date is 1 January 2018. Thank you. I will now hand over to Rakesh to discuss future prospects.
Thank you, Amy. My presentation today is going to have 4 distinct sections: geopolitical landscape, US defence outlays, second half 2017 revenue, and an update to the long-term opportunities. So first, onto the geopolitical landscape. The geopolitical landscape is generally as presented at the prelim presentation earlier this year. Therefore, I intend to focus on the minor changes and nuances. First, North America. You will have read that defence spending is on the increase in both Canada and the US. Canada has declared its intent to near double defence spending by 2020. The majority of this increased investment is to build ships to patrol and defend the opening of the Arctic Circle passage between the Atlantic and the Pacific. As I have mentioned before, a defence-friendly White House, House, and Senate is supportive of an increased investment budget, as is being demonstrated in the FY18 requests and the positioning for FY19. However, it is by no means straightforward. The Democrats still want an increase in non-discretionary spending before they will agree to vote for an increased defence budget. With the recent weakening of the GOP, the Democrats are feeling stronger and emboldened. Additionally, the recent announcement of the potential absence of John McCain through illness is a worrying setback. John is a vocal supporter of the military and the need to keep it properly equipped, as well as being able to cross the aisle to garner support from both parties. His anticipated absence will be keenly felt. Second, the UK. We continue to have concerns about the UK market. At best, defence currently comes 6th in the government's pecking order, after healthcare, social care, police, education, and now building safety. I do not anticipate any new money until 2020. Third, mainland Europe. Merkel has indicated that Europe must be in control of its own destiny. Consequently, we have seen indications of rising defence spending, although France has recently announced a cut to bring their economy back into EU guidelines as an example to other countries. Any increased funding, however, will favour national champions over ultra, as defence is not an open market. Finally, the Middle East and Asia Pacific. Both regions have a need to increase defence spending, but contrastingly for different reasons. The former for terrorism and the latter for Chinese ambitions and North Korean volatility. The Middle East is still preoccupied by regional tensions with Yemen, Qatar, and Iran. This in turn slows spending on improving defence capability in favour of war materiel. This is further exacerbated by the oil price refusing to budge from less than $50 per barrel of oil. The oil price is also causing a cash crisis in this region, with many companies suffering significant negative cash flows on their contracts. The Asia Pacific is experiencing a mini arms race reminiscent of the Cold War. Many opportunities exist, not only for new platforms and systems, but also for the upgrade and refresh of legacy systems. Anti-submarine warfare is a growing requirement, with many nations becoming submarine hunters for the first time. This is being helped by the export of the Boeing P-8 Poseidon and the Lockheed SH-60 Romeo ASW platforms. On to the next slide. We have done more analysis of Ultra's performance relative to the US market. I thought that the result may be of interest as it forms the backdrop to the investment case in Ultra. This graph takes the publicly available US defence outlays over the indicated years as a percentage of growth in spend in calendar year and plots it alongside the organic revenue growth percentage generated by Ultra. Within the Ultra numbers, we have omitted the one-off effect of the cancellation of the Oman contract and the impairment of the Prologic business. However, the correlation is still evident with those effects in or out. The result is, as you can clearly see, that there is a strong correlation between the two, with a lag of 18 months to 2 years. You will also remember that I have previously said on many occasions that I do not watch or concern myself with the level of the US defense budget. I watch more closely the US defense outlays, as it is a clearer picture of whether the US DoD is actually spending the money. The US defense outlays for calendar year 16 of the investment budget was up 1.3%, the first time in 5 years. And for the calendar year to end of June 2017, it was up 4%. I am heartened by this as a leading indicator of organic revenue growth for Ultra. The group can grow in the US at a faster rate than the growth in defense outlays because we are in 2 of the 3 sweet spots experiencing increased spending, being underwater warfare and especially anti-submarine warfare and electronic warfare. The third is ballistic missile defense, where Ultra has a small supplier position. This data should allow you to see the case for organic growth in Ultra in the future. Turning now to how I see the second half of 2017 developing. The required second half performance is typical for Ultra, but I'd like to provide a little more detail to demonstrate why we have confidence in delivering our guidance for this year. On this slide, you can see that our order cover at the end of June is 82% of the full year revenue. This is broadly in line with 2016 at 84% and 2015 at 83%, remembering that we had a CR this year till early May. That means that we have to book 18% in the second half and ship it by the end of December. Currently, the total value of bids outstanding and opportunities yet to bid that will provide revenue this year is 413% of the book and ship needed. Let me also provide you with the flash results for July. Please bear in mind that because this data is gleaned from our flash process, it may not be wholly accurate, but is indicative of the month's results. In July, we had an order intake of about £70 million and revenues of approximately £44 million. Consequently, our order cover for full year revenue is now 86%, which is exactly the same at this point as 2016. This leaves 14% as the book and ship. Major orders booked in July include Indian Navy Defence Systems, where we are not disclosing the value owing to the customer's request, South Korea sonobuoys at $5 million, P-8 sonobuoy receiver refresh at $4 million, US Navy cybersecurity at $3 million. Moving on to the next slide. This slide is an update to the one presented earlier this year. I have removed the programs that were won at the time of the prelims and added 4 more items, being US Virginia-class follow-on, UK encryption and key management, UK RAF secure radio upgrade, and nuclear sensors build and support. First, the US Virginia-class. Our business in Long Island, New York, has been on the Virginia-class submarine since the start of the program. This opportunity is for the next flight of submarines and therefore has a high probability of proceeding and that we will get the award. I cannot go into the details of what the system is, as even the nature of it is classified. Second, UK encryption and key management. Ultra has been selected to support the UK government's sovereign encryption and key management requirements. Orders will be placed for a combination of engineering contracts towards the end of 2017. These will be followed by a significant production program in the future. Third, the RAF secure radio upgrade. Ultra is providing encryption and secure communication upgrades to the UK's Typhoon aircraft. An engineering contract of approximately £4 million is to be placed in the last quarter of 2017, followed by production orders in 2018. Through life support will be additional to this. Finally, the nuclear sensors. Ultra is involved in multiple live programs as it continues to replace and upgrade aging US nuclear power plants with both existing products and newly qualified sensors, extending the product range. Moving on to the summary. As you have seen and heard, the first half of 2017 has been busy. Despite the CR lasting until early May, our order intake has held up very well, a trend that we have seen continue into July, with the award of the contract from the Indian MOD. As the banner says at the bottom of this slide, we have been executing the strategy and the goals that we communicated last year in an efficient and timely manner. This bodes well for the end of this year as well as beyond. Whilst delivering the operational performance, we have also agreed a conditional merger with Spartan. This illustrates that we have the management depth and breadth, as well as the organisational resilience, to deliver the organic revenue growth as well as any acquisition growth. Even though we have seen an improvement in the US and Asia Pacific markets, we are not complacent. The world continues to be a volatile place, and geopolitics could alter defence budgets for the better or the worse. We have been prudent in our forecasts by excluding certain export opportunities where the timing is unpredictable. Finally, our guidance for the full year and 2018 is maintained. It could be a little bit higher if yet more export contracts are secured. It could be a little bit lower if a CR were to extend into 2018. A situation very similar to last year, but now with a few more data points from which to base the forecast. Thank you. That is the end of our presentation.